Hello, everyone. Let's start our today's discussion. I hope you remember that in the previous class, we started our revision session on June 2021 exam. Today, we are moving forward and we will look at its question number 2. I want you all to concentrate and listen to me very carefully. Okay? It will be very good if you will keep the past paper question open with you also, and you will keep your summary notes along with yourself. Okay, let's start read this question and we'll develop the answer in the same manner in which we did for question number 1. Okay, now you should assume that today's date is 1st June 2021. Your manager has had a meeting with Fiona, a potential new client of your firm. Extracts from the memorandum prepared by your manager following the meeting from an email which details the work you are required to do are included in the exhibits. Now, this is some basic reading. Normally, no useful data is given in it. The following exhibits are available on the left-hand side of the screen, provide relevant information. Number 1 is memorandum extract from your manager, and number 2 is an email extract. The information should be used to answer the requirements within your chosen response. Okay. Now, you all know that we have 2 response options available. We can answer on word processor and we can answer on spreadsheet. But I normally recommend my students to go for word processor. Reason being that it is very easy to answer on a single screen rather than using 2 screens that write some on spreadsheet and then do some on word processor. So we use a manual calculator, and in word processor we use tables to cover the requirement, to cover the need, I would say, of spreadsheet. But if someone uses both of them, that is also acceptable. The only important thing is that you have to give a proper reference that, okay, this part or this working is done in the spreadsheet. This all basic discussion was done earlier also, but since we are doing a new question, so I will repeat some instructions along with the discussion. Okay, now let's read the memorandum extract from your manager. Now, Fiona is 74 years old and is in poor health. She has lived in the country of Kerala since 1990. She has a son Hugo and a daughter Elena, both of whom live in UK. Fiona will move to the UK on 1st August 2021 and acquire a home there. Okay. Now, as I always say to my students is that when you read the question for the first time, don't rush and don't get frustrated. While reading the question for the first time, there can be many of the data which you may not understand very good. But once we read the requirements and then we do specific reading, the things get clear. So don't rush, okay? So Fiona is 74 years old. She's in poor health. She has lived in country of Kerala. Now her son and her daughter live in UK. Fiona will move to UK on 1st August. Okay, now I have already established that as a result of moving to UK, Fiona will become UK resident on 1st August 2021 under the split year basis. Now, what do you mean by split year basis? Split year basis means that she will become resident from the date she arrives in UK. Now, normally the residency status changes after a complete fiscal year. But when split year basis apply, the residency status changes immediately. Now, this means that after 1st August 2021, she will be treated as a UK resident. Fiona will also be UK resident in the tax year 2022-23. Fiona is domiciled in Kerala. However, once she becomes UK resident, Fiona will be deemed domiciled in the UK for the purpose of income tax and capital gain tax because she was born in the UK with a UK domicile of origin. Okay, so now what state data he has given? That on 1st August 2021, she becomes UK resident through split year. Then in 22-23 also she will be resident. Okay, her actual domicile is of Kerala, but for income tax and CGT, we will assume her as deemed domicile. Now you have studied the concept of deemed domicile in individual income tax and CGT chapter. I hope you people remember. Okay, now, gifts made by Fiona. On 1st May 2020, Fiona gave Elena cash for £30,000. The money was transferred from one of the Fiona's UK bank account. Fiona's previous gifts are set out below. These were all the gifts of assets located in UK, such that they were subject to UK inheritance tax, despite Fiona being domiciled in Kerala. The amounts shown are after deduction of any available annual exemptions. 1st August 2012, there was a PAT, a potentially exempt transfer of 94,000. 1st July 2015, there was a chargeable lifetime transfer of 74,000. 1st September 2019, there was a potentially exempt transfer of 204,000. When Fiona's husband died in 2012, the whole of his nil rate band was used when calculating the IHT liability. Now, this means that there is no transfer of NRB involved in the question. Gifts to be made to Hugo. Fiona owns a number of houses, which she rents out to long-term residential tenants. These houses are located in either Kerala or UK. Fiona intends to give one of these houses, either Aber House or Blab House, to Hugo within the next 3 months. Both of these houses were acquired in May 2016. CGT gift relief will not be available in respect of gift of either property. The expected gain or loss. So he has already given us the expected gain loss. So let's see that what he will ask. Aber House is located in Kerala. It will give a loss of 50,000. Blab House is located in UK and it will give a gain of 85,000. Property and interest income. Fiona's anticipated income for the tax year 22-23, the year after she moves to UK, is set out below. Property income, property situated in UK, it gives income of 26,000. Property situated in Kerala, they give property income of 31,000. Then she has some interest income from UK bank account, 1,700, and Kerala bank account, 1,200. Okay. Now, it's an easy question, so don't rush. Just listen to me carefully. We are just reading the question. I will talk on the question very detailed while we'll be doing the requirements, okay? So don't worry about it. The income arising in Kerala is stated gross of Keralian tax. Fiona will remit all of the rental income in respect of the property situated in Kerala to UK. She will remit all the rental income. The interest arising on the Keralian bank account will be retained in Kerala. This means that this 1,200 will be unremitted. This rental income will be remitted. See, the income arising in Kerala is stated gross. Okay, Fiona will remit all of the rental income. This Kerala rental income will be remitted. The UK amount is already in UK. The rental income of 31,000 will be remitted. The interest arising on Keralian bank account will be retained in Kerala. This means that 1,200 will remain unremitted. Okay. Tax system in Kerala is that rate of tax is 18%. There is no CGT or IHT. There is no double tax treaty. Okay, we'll see. Then there is an email extract from our manager. Let's read that also. Normally, these email extracts tell us about the requirement. Becoming Fiona's tax advisor. Explain the actions that we should carry out before we become Fiona's tax advisor. I already obtained her address and proof of identity. Now, these are the easiest marks. Now, what are the actions which we do before accepting the engagement to become a tax advisor? We look at the code of ethics. We take approval from the previous tax advisor. We look at the source of income, okay, that whether she's involved in money laundering or things like that. We think about our competencies, whether we'll be able to deal with the client, whether we have sufficient resources. So what are the matters which we consider before accepting the client? Now, every time in exam, there will be these professional marks. So many students ask me that, sir, how to deal with these ethics and professional marks. Now, these are some standard requirements. When we'll be doing more and more past papers, they will get clear, but they are very easy. You deal with questions like these in SBR also. You deal with requirements like these in advanced audit and assurance also. Okay, so these are ethics requirements, normally 5 marks or come in the exam like these. So these are some very easy requirements. So do we need to study them separately? No. Just while doing the past papers, you will understand that there are a bunch of requirements in relation to ethics, which are very simple and very straightforward. And the examiner asks them in routine. So don't worry about it. While we develop the answer to this, you will understand that also. Then there is part B. So before moving to part B, let's look at the marks for part A. So if I look at the marks of part A, becoming FIUNA's tax advisor gives us 5 marks. Okay, so let's deal with this first before moving towards other requirements. Okay, so the name of question is FIUNA. FIUNA. Okay, just a second. This is all our requirements, so I will change it. Okay. Now, so we are attempting the first requirements, which is very easy, 5 marks, becoming FIUNA's tax advisor. Okay. Now, what did he ask? Explain the actions which we should carry out before we become FIUNA's tax advisor. I have already obtained her address and proof of identity. Now, just think, if you are becoming a tax advisor to a new client, what you will do? Okay. We will consider about integrity of FIUNA as it is a requirement of professional code of ethics. In order to do this, we will consider any ongoing tax inquiries against FIUNA. Okay, these may create concern on FIUNA's integrity. Okay, now whenever you accept a client, now just think that you are a firm of accountants, you have to look at the professional code of ethics. So you think about integrity of the client, you think about your own competence. Okay, you think about money laundering issues because you are accepting a tax client. You take a confirmation from the previous tax advisor that why did they resign. So these are some routine points. And if you have already passed advanced audit and assurance, now you must remember that in AAA exam, we study a complete chapter on professional acceptance. That what are the steps to move forward through professional acceptance. And if someone haven't studied AAA, so they also should not worry, because when we'll do the past papers, you will understand these requirements related to ethics. These are easy ones, not difficult ones. Okay. Further, as FIUNA lives overseas, as FIUNA have overseas incomes also, therefore our firm should consider about their legitimate sources, as there may be a concern of money laundering. Okay, whenever someone is earning overseas, there can be a concern of money laundering. Further, our firm should take professional clearance from previous tax advisor of FIUNA and should inquire about reason of not doing current year tax engagement. Now, this is the requirement of code of ethics, that you have to take approval from the previous tax advisor, or For example, if you are accepting an accounting engagement, you take clearance from the previous accounting advisor. Even if you are auditor, you take approval from the previous auditor, and you ask them that, why did you resign? Why are you not doing the work? Maybe they tell us that these are unethical people, so we should also avoid them. Okay. So the first thing was about integrity. Second one was about money laundering. Third one was about professional clearance. Then we should think about our own competence. Our firm should also evaluate uh, its own competence, in relation to dealing with tax affairs of Fiona, as Fiona is also earns overseas incomes, Therefore, some complex tax issues may be involved. Okay. And lastly, our firm should consider about availability of resources and deadline required by Fiona to complete her tax engagement. If our firm lacks sufficient resources, then disagreement will arise on completion of work. This is very important, that whether the firm has sufficient team members available or not. So if you look at it, these are very easy 5 marks. Now, these were cash marks, and when you will go through multiple past papers, you will find that requirements in relation to ethics are normally same. A bunch of requirements come repeatedly. A series of requirements, a bunch of requirements come repeatedly. Okay, so I will repeat it again. What are the actions or the matters which we should consider before accepting the tax engagement of Fiona? So we will consider about the integrity of Fiona. Okay, that if there are any ongoing tax inquiries against her, any integrity issue, obviously it's a matter of code of ethics. We need to think about it. Further, we need to think about money laundering issues. We need to think about the professional clearance from the previous tax advisor. We need to think about our own competence, and we need to think about availability of resources. So these are the list of points or list of actions which we have to consider before accepting the Fiona's tax engagement. Is it clear? So if you read the requirement again, it was of 5 marks. Okay. Now, since there are no professional marks available in the question, like in the question number 1, there were professional marks, the separate professional marks at the end. So in the question number 1, we made format of email also. Since in this question, there are no professional marks available, so we didn't make the format of the email. Okay. We will write down every requirement and we'll just answer it. These 5 marks were relating to ethics. Okay. And what did he ask? Explain the actions which we should carry out before becoming the Fiona's tax advisor. I have already obtained her address and proof of her identity. So I said, okay, you have the address, you have verified her proof of identity. So what else we'll do? We'll talk to the previous tax advisor. What else we'll do? Okay, just think, give it a thought. What else we can do? We can look at his source of income, because he has just looked at his identity. We'll look at the source of income. We look at our own competence. We look at the availability of resources with our firm. So these are the list of things which we normally do while we accept a client. Okay, now if you have already studied AAA, as I said earlier, the Advanced Audit and Assurance, In AAA, we could study a complete chapter of professional clearance. But if you haven't studied, then I hope you remember that in strategic business reporting, in SBR, and then in SBL paper also, you have requirements like these of ethics. And if you haven't studied any of these papers, then also don't worry, because when we'll do series of past paper, you will get to know that these series of requirements are almost same and they are not very much difficult. Okay, let's move to second requirement. That was gifts to Elena and Hugo, which is part B. We haven't read the requirement yet, the email yet. Just I'm copying and pasting it. The part 1 is inheritance tax payable in respect of Fiona's gift, which is of 3 marks. The 3 marks should be easy one. Just copy and paste the requirements so that it is easy for the examiner to check my paper. Now, let's read the email, what he is asking. You should assume that Fiona's death will occur on April 23. Inheritance tax payable in respect of the Fiona's gift on 1st May 2020. Calculate the inheritance tax payable as a result of Fiona's death in respect of the gift made by Fiona to Elena on 1st May 2020. Okay, now if the Fiona will die on 30th April 2023, we need to calculate the IHT that will be payable in respect of the gift made by Fiona to Elena on 1st May 2020. Okay, now what was the gift? Don't rush. Easy requirement of 3 marks. Okay, don't rush. So it was here. On 1st May 2020, Fiona gave £430,000 in cash. The money was transferred from one of the Fiona's UK bank account. Okay, now, gift made by Fiona to Elena of £430,000 cash. Okay. I will keep it as copied of £430,000 cash on 1st May 2020 was a potentially exempt transfer. Okay, there was no lifetime tax on it. Okay, now listen to me. However, as Fiona died on, now what is the date given in the question that Fiona will die on? 30th April 2023. Listen to me, don't rush. However, as Fiona died on 30th April 2023, which is within 7 years of gift, therefore, this potentially exempt transfer will get chargeable. Okay, I will write that here in brackets so that I can use this abbreviation every time. Exempt transfer. Okay, I will repeat it again. What you need to understand is that the gift of 430,000 made in May 2020 was a potentially exempt transfer. There were no lifetime gifts. However, as Fiona died on 30th April 23. Now, when you die within 7 years of the gift, the death tax get applicable. Okay, therefore, PAT will get chargeable to death tax. Okay, now let's make a table. I'll not write too much narrative because it is just of 3 marks. Okay, don't forget, it is just of 3 marks. Okay, now, so what was the value of transfer? The value of transfer was 430,000. Okay, gift made in May 2020. So it is fiscal year of 2021. Then we will deduct annual exemption. Okay, current year 2021. Let's look at other gifts, that whether annual exemption is available or not. The other gifts were of 2012, July 2015, and September 2019. Now, September 2019 means 1920. Okay, so 1920 annual exemption is used against other gift, but 2021 is available. 3,000. Then annual exemption previous year 1920, but that is used. I will put a 0. Okay, if someone don't use this pound sign, that is also good. The examiner will not deduct marks, but I normally prefer to do as much as I can do. But in exam, obviously, I know that you have time pressure. So don't try and do in the same way like I do. Okay, already used against gift made on, now what was the date of the gift? September 2019. Okay, so the annual exemption was already used in September 2019. Now, so this gives me value of potentially exempt transfer. So it's 427,000. Now, no lifetime tax on PAT. Now we will move towards death tax. Okay. Now let's look at the death tax. Nil rate band of death year. What was the nil rate band of death year? 325,000. Now what is the date of death? Death on 30th April 2023. So it's 23-24. Obviously, its nil rate band continues at 325. You can look at the tax rate sheet. Now, the examiner has said that for every year you can use 325. Last 7 years, chargeable transfer. Okay. Gift date is May 2020. Last 7 years, chargeable transfers will include transfers between May 2020 to May 2030. Obviously, if you go back 7 years, just use your mind. Now, what we do is, first from the death till 7 year, we identify the transfers on which death tax will apply. And then we go back 7 years from each gift. I'll repeat it again. First, we look at the 7 years of the death to identify the transfers on which the death tax will apply. First, we identify the transfers on which the death tax will apply. Once we have identified this, the transfers on which the death tax will apply. The 7 years of death, the transfers on which death tax will apply. And then we go back 7 years from each gift. So gift date is May 2020. Last 7 year chargeable transfers will include transfers between 2020 to May 2013. So let's look at the transfers. Now this is of 2012, we'll ignore it. 2015 and 2019, 74,000 and 204,000. These are last 7 year chargeable transfers. Okay. And this PAT is also chargeable for death tax because it lies in 7 years of death. Okay. So 74 and 204. I will repeat it again. So if someone is any concern, it will get clear. Okay. 74,000 and 204,000. So this gives me available nil rate band of how much? 325,000 minus 74 minus 204. So it's 47,000. The column size have increased. Okay. Now, so the available NRB is 74,000. I will repeat it again. If someone has any query, it will get clear. First of all, we looked at the value of transfer. that was for 30,000. We deducted the annual exemption of current year, 3,000. Last year annual exemption was already used against the gift made in September 2009. Okay, so the value of potentially exempt transfer was 427. Okay, now no lifetime tax on PAT. Then we started calculating the death tax. Nil rate band of death year is 325,000. Now, since Fiona died within 7 years of gift, okay, if you look at the email here, he says, calculate the inheritance tax IHT payable as a result of Fiona's death in respect of the gift made by Fiona to Elena on 1st May 2020. And we have to assume that Fiona will die on 30th April 23. So if you die within 7 years, what happens is, when you die within 7 years, what happens is that your gift gets chargeable. Okay, so the nil rate band. Now we'll deduct the last 7-year chargeable transfers. Now the gift date is May 2020. We'll go back 7 years. So May 2030. So what are the gifts? This August 2012 will obviously be ignored. July 15, a CLT of 74,000. Here it is given that all the exemptions are already deducted from these. So this CLT is chargeable and this PAT is also chargeable. Now this PAT is also a chargeable transfer because it lies in 7 years of death. The death is in 2023 and this was of September 19. So when I adjust both of them, I get available NRV. Okay. Now let's look at IHT. Death tax. So what will be the death tax? On first 47,000, we will apply 0%. So this gives us 0. And on the remaining, how much is remaining? The PAT value is 427. So 427,000 minus 47,000 on which we apply 0%. So 427 minus 47. This gives me 380,000. And I will apply 40% on it. This gives me inheritance tax of 152,000. Okay, I will repeat it again. These 3 marks were very easy. Now, if you wouldn't have write so much commentary on the right column, there would be no issue. IHT 152,000. Because these were just 3 marks, so examiner wouldn't have expected you to write so much narrative. I will repeat it again. I want you all to concentrate on it. Let's look at it. The first part was very easy. That what are the matters or actions we will take before accepting the Fiona's tax engagement. So ethics requirements, I don't feel them difficult. I think that they are pretty much straightforward as these are routine requirements. Then there was part B1. These 3 marks were also very easy. IHT payable in respect of Fiona's gift on 1st May 2020. Gift made by Fiona to Elena on 430,000 was a PAT, and there is no lifetime tax on PAT. But since Fiona will die within 7 years, so there will be death tax. So 430,000 minus 3,000 for annual exemption, this gives me PAT of 427. No lifetime tax on PAT, and then we talked about death tax, that the nil rate band was 325. Okay, for the death year. Last 7-year chargeable transfers, there were 2 chargeable transfers between May 20 to May 13. This gave us available NRV, and then we simply applied the death tax. Is it clear? So how many marks are done? 5 marks becoming Fiona's tax advisor and 3 marks for simple IHT calculation. I hope that till here it's simple. Okay, please confirm me. Is it good? If you have any query, you people can ask me on WhatsApp. Okay, now let's move to another part. Propose gift to Hugo. 7 marks. Let's look at it. Propose gift to Hugo for 7 marks. Let's look at it. So in relation to proposed gift to Hugo, let's read the memorandum and the email so that we can find more detail and then we can start solving it. So if we read email extract from the manager, proposed gift to Hugo, part 2. In respect of the Fiona's proposed gift to Hugo, explain for each of the two houses whether or not a chargeable gain or an allowable capital loss will arise in UK, whether or not gift will be within the charge to UK IHT. So there is some proposed gift to Hugo on which we have to comment that whether the capital gain or capital loss will be assessed in UK. And secondly, we have to discuss that whether it will be chargeable in inheritance tax or not. On the basis of your explanation, advise Fiona which of the two houses she should give to Hugo and whether the gift should be made before or after Fiona has moved to the UK. You should not prepare any calculation for this part of the question. So there is some proposed gift to Hugo and we have to talk on its CGT implication and we have to talk on its IHT implication. Okay, whether or not gain or loss will arise in UK. Secondly, whether or not it will be subject to UK IHT. And then we have to advise that which of the two houses should be given to Hugo and whether the gift should be made before or after Fiona has moved to the UK. Okay, let's read that what is this gift to be made to Hugo. Let's read it. Fiona owns a number of houses which she rents out to long-term residential tenants. These houses are either located in Kerala or UK. Fiona intends to give one of these houses, either Aber House or Blab House, to UK within the next 3 months. Both of the houses were acquired in May 2016. CGT gift relief will not be available in respect of a gift of either property. The expected gain, loss on the disposal of each of the two houses. Aber House is located in Kerala. Blab House is located in UK. On Aber House, we will have a loss. On Blab House, we will have a gain. Okay, listen to me carefully, you will be able to understand. Fiona is planning to gift either of the house. Fiona is planning to gift either of the house to Hugo. Now, one is Aber House, which is located in Kerala, and one is Blab House, which is located in UK. Now, what we have to comment, if you look at the email, he says, in respect of Fiona's proposed gift to Hugo, explain for each of the two houses whether or not chargeable gain, or allowable loss will arise in UK. First of all, we have to comment on gain or loss, that whether it will be assessed in UK. And then we have to comment on the inheritance tax. On the basis of your explanation, advise Fiona which of the houses she should give to Hugo and whether the gift should be made before or after Fiona moved to the UK. Okay, so let's look at it. Okay, let's look at it. Now let's talk about the proposed gift to Hugo. And first of all, we will comment on capital gain tax implication. I want you all to listen to me very carefully. Capital gains tax implication. Now, please listen to me. Now, the first house. Okay, don't rush. He has clearly stated that we are not required to do any calculation. We just need to do commentary, and this commentary is of 7 marks. Okay, listen to me. Now, the first house is Aber House, which is located in Kerala, and it is giving us a loss of 50,000. Okay, now listen to me very carefully. Now, this is an overseas capital loss. Overseas capital loss will only be assessed if Fiona is UK resident. if I give you a basic revision of individual overseas, if a person is UK resident, listen to me, if a person is UK resident, his UK and overseas gains and losses are assessed in UK. But if a person is not a UK resident, he only pays tax on UK gains and losses. Please listen to me carefully. Please wake up. Hello. Please listen to me. If you don't remember the rules, open the summary notes. Listen to me carefully. If a person is UK resident, if a person is UK resident, his UK and overseas gains and losses are assessed in UK. But if a person is not a UK resident, he only assesses UK gains and losses. If you look at Fiona, here is some detail given. Fiona will become UK resident on 1st August 2021 under split year basis. And she will move to UK on 1st August 2021. Okay, now listen to me what I'm writing. Capital loss of Aberhouse, will only be assessed in UK if Fiona is UK resident, as capital loss of Aberhouse is a loss on overseas asset. Please listen to me. I will repeat everything. The key is that you don't have to rush. You have to listen to me very carefully. Capital loss of Aberhouse will only be assessed in UK if Fiona is UK resident, as capital loss of Aberhouse is a loss on overseas asset. Okay, it is a loss on overseas asset. Listen to me. Now, Fiona will become UK resident. When she arrives in UK on 1st August 2021. Okay, so if she gifts Aberhouse before coming to UK, then there will be no capital loss relief. However, if she gives Aberhouse after coming to UK, then capital loss relief will be available. Okay? Please listen to me carefully. Believe me, you will be able to understand it. The only important thing is patience, concentration, and focus. Capital loss of Aberhouse will only be assessed in UK if Fiona is UK resident. Now, this is the very basic statement of individual overseas. That if a person is UK resident, his UK and overseas gains and losses are assessed in UK. But if a person is not a UK resident, only UK gains and losses are assessed. Now, capital loss of Aberhouse will only be assessed in UK if Fiona is UK resident, as capital loss of Aberhouse is a loss on overseas asset. Fiona will become UK resident when she arrives in UK on 1st August 2021. It was stated in the question that she will become resident through split year, which means on the same date. So if she gifts Aberhouse before coming to UK, then there will be no capital loss. However, if she gives Aberhouse after coming to UK, then capital loss relief will be available. Okay. Now, this is, we talked about the Aberhouse, which is located in Kerala, and there was a loss of 50,000. The second one is a Blab House, which is located in UK, and there is a gain of 85,000. That is very simple. Capital gain on Blab House will be subject to UK CGT irrespective of Fiona's UK residency status. Why? As it is a gain on asset located in UK. As it is a gain on asset located in UK. After 6th April 2015, all UK residential properties are subject to UK CGT irrespective of residency status of a taxpayer. This means that Blab House capital gain will be subject to UK CGT irrespective of whether it is gifted before or after arriving to UK. I will repeat it again. I want you all to listen to me very, very, very carefully. Listen to me. Let's read the email again. What he's asking, proposed gift to Hugo. In respect of Fiona's proposed gift to Hugo, explain for each of the two houses. This means we have to comment on Aber House and we have to comment on the other one, which is Blood House. Whether or not a capital gain or allowable loss will arise in UK, which means we have to talk about CGT assessment. And the second one is IHT. We haven't discussed about IHT yet. On the basis of your explanation, advise Fiona which of the two houses she should give to Hugo. So you have to give advice. We'll give it at the end of the answer. And whether the gift should be made before or after Fiona moved to the UK. Okay. So we have to give the advice also. And we are commenting on the timing also. So, first one was capital loss of Aber House. It is a capital loss on overseas asset. It is a capital loss on overseas asset. Now, in overseas asset, we are talking about overseas capital loss. It will only be assessed in UK if Fiona is UK resident. It will only be assessed in UK if Fiona is UK resident. If Fiona is not a UK resident, this loss will not be assessed in UK. Okay? Because it's a loss on overseas asset. And then we talked about Blab House, which was a UK asset. You have studied 6th April 2015 rule. The tax department has withdrawn the exemption of non-residents. Okay? All the properties will get subject to tax. Now let's talk about inheritance implication. Now let's talk about inheritance tax implication. Now I hope you remember that in inheritance tax, we look at the domicile status. We don't look at the residency status. Now, the one house is a Blab House which is located in UK. Now, if you will use your mind, you will answer about Blab House first. Because it is a UK asset, and on UK asset, the IHT applies irrespective. Blab House is located in UK. Its gift will be subject to UK IHT irrespective of Fiona's domicile status. This means that whether she gifts it before or after arriving to UK, this gift will be subject to UK IHT. If an asset is located in UK, it will be subject to UK IHT in any way. Okay, but if the asset is located in overseas, in that case, we need to be UK domicile holder. In relation to Aber House, UK IHT will only arise on its gift if Fiona is UK domicile holder at time of its gift, as it is an overseas asset. See, if an asset is an overseas asset, we need to be a domicile holder. If an asset is an overseas asset, we need to be a domicile holder. But for UK asset, the IHT will apply irrespective. In case of our house, we need to be a domicile holder, then only UK IHT will arise. Now, what is the domicile status? Let's look at it. I think it was given above, somewhere here. Fiona is domiciled in Kerala. However, once she becomes UK resident, Fiona will be deemed domiciled in the UK for the purpose of income tax and CGT because she was born in UK with a UK domicile. Now, Fiona don't have actual domicile status. For deemed domicile in IHT, see, here he is confusing us. She is deemed domicile for income tax and CGT. For inheritance tax, deemed domicile is something different. In inheritance tax, if we are born in UK and we had UK domicile of birth, we were born in UK and then we moved away. We get deemed domicile if we are resident in the current year and in any of the previous 2 years. This means for IHT deemed domicile, we need residency of 2 years at least. See, if someone has forgotten the rules, I'm saying it again, there is no shame in revising the rules through summary notes. Or at least you can keep the summary notes open along with the lecture so that, okay, you can see, oh, yes, this was the point. And then you can learn it later. But keep the summary notes along with you. See, Fiona do not have actual domicile because her actual domicile is of Kerala. So we need to look at deemed domicile. For deemed domicile, for a person who was born in UK, we need to be resident for at least 2 years. Current year and 1 year in the preceding 2 years. We need to be domiciled, we need to be resident for at least 2 years. Now, if we talk about Fiona, and if you look at the requirement, or the email, he's saying that you should assume, if you look at it, she's expected to die in 30th April 2023. I think in requirement, yes, here the date is given. It got hidden behind my camera. You should assume that today's date is June 2021. So June 2021 is 21-22. And currently, she has not arrived in UK because she will arrive in UK or in August 2021. Okay. So in any case, if she gives before arrival or she gives after arrival, it will be a gift in 2021-22. Now, even if she becomes resident in 2021-22, she is not resident in the previous years. For deemed domicile status of IHT, you need to be resident for at least 2 years, the current year and 1 year in preceding 2 years. Preceding means the previous ones. So she would be resident in the current year, but in preceding 2 years, she was not in UK because she'll arrive in UK in 1st August 2021. Listen to me while I'm writing the answer. I will repeat each and everything. In relation to our house, UK IHT will only arise on gift if Fiona is UK domicile holder at a time of gift, as it is an overseas asset. Fiona is not a UK actual domicile holder as she holds domicile of Kerala. Okay. For deemed domicile status, in IHT, it is necessary that a person is UK resident in current fiscal year and, not or, and in any of previous 2 fiscal years. In case of Fiona, she will not be a UK, she will not be a deemed domicile holder as she is not resident in previous tax years when she arrives in UK in August 2021. Okay? This means that gift of Aber House will not be subject to UK IHT irrespective of gifted before arriving to UK or after arriving to UK. I will repeat this part again and then I will write a conclusion because he told us to give the advice. So you can name it as conclusion or you can name it as an advice. See, I would say that this part of the question is a bit tricky. But what I always say is that if you look at the previous ones, this part A was a cash marks. This part B1 was very easy. So if the examiner has given us a few marks as tricky, you should accept it because after all, it's advanced taxation. Okay, so we are talking about proposed gift to Hugo. First of all, we commented on the capital gain tax implication, and then we commented on inheritance tax implication. First of all, we commented on capital gain tax implication, and then we commented on inheritance tax implication. He asked us that comment that whether these two houses will be assessed for UK CGT and for UK IHT. So first of all, capital loss of Aber House. Capital loss of Aber House. Now, Aber House is an overseas asset. Listen to me. Aber House is an overseas asset. Overseas asset, listen to me. Overseas asset only gets subject to UK CGT if you are UK resident. Overseas asset only gets subject to UK CGT if you are UK resident. So the loss of our house will only be assessed in UK if Fiona is UK resident, and she will become UK resident on 1st of August 2021. Okay? When we talk about Blab House, it is a UK asset. On UK asset, the CGT will apply. On UK asset, CGT will apply irrespective of your residency. Because after 6 April 2015, overseas people have also have to pay UK CGT on residential properties. Then there was IHT. Blab House is an asset located in UK. So irrespective of your domicile status, irrespective of when you come, UK asset, you have to pay IHT. But when you talk about Aber House, it is an overseas asset. For overseas asset, UK IHT is only payable if you are UK domicile holder. Now, Fiona is not a domicile holder. Her actual domicile is of Kerala. But sir, what about deemed domicile? Now the examiner played with you here. He said that she's deemed domicile for income tax and CGT. Now some students will get stuck in his track. She is deemed domicile for UK income tax and CGT, not for IHT. If you remember the rules of individual overseas, I will say it again, open your summary notes. If you will look at your summary notes, you will find that when we talk about deemed domicile status in IHT, for a person who was born in UK, you need to be resident in the current year and in any of the 2 preceding years. Okay? So, she may be resident in the current year, but she's not resident in any of the previous 2 preceding years because she has just arrived UK. So, Aber House, no IHT because it is an overseas asset. and you are not a domicile holder. Now, what should be the advice? Now, listen to me. Fiona should give ever house to Hugo. Why? And Fiona should give ever house to Hugo. Number one. And when she should give ever house to Hugo after arriving to UK. Now, what is the reason of my advice? If she does this, then capital loss of ever house will get allowable in UK. Okay, there is no IHT on ever house, irrespective of gift before or after arrival to UK. Now, sir, if she would have given Blab House, and Blab House, the gain will also get chargeable and IHT will also get payable. So we have to save her tax. We don't have to get her stuck. So ever house is advisable. And ever house also after arriving to UK, so that the loss gets allowable. And there is no IHT on ever house irrespective of when you gift, because you are not a domicile holder. This was a bit tricky part. Let's look at it again. Let's take a review of the question from the very start. We started with part A, where we were talking about becoming Fiona's tax advisor. But this was something very simple. That before accepting the tax engagement, what are the actions which we should take? The second part was simple IHT calculation. Even a basic tax student would have also done it. Simple IHT calculation. And then part B2 was a bit tricky one. Proposed gift to Hugo. He asked us to comment on capital gains tax and on inheritance tax implications. On capital gains tax and on inheritance tax implications of gifting Aber House, which is an overseas asset, and of gifting Blab House, which is a UK asset. So for overseas asset, loss is only allowable. For overseas asset, the loss is only allowable if you are UK resident. For overseas asset, the loss is only allowable if you are UK resident. Okay? For UK asset, the gain will be chargeable always. For inheritance tax, UK asset will be subject to UK IHT always. And for overseas asset, in IHT, you need to be a UK domicile holder. Now, she don't have a UK domicile. She has actual domicile of Kerala. And she don't have deemed domicile of UK either, because she haven't spent 2 years in UK. And then lastly, we gave advice. Now, I will say one thing. This is very important. If you don't remember the rules and you are not revising the rules, there is nothing I can do for you. If you don't remember the rules, there is nothing to worry. Still, you have time. You can revise it today. Start it today. Open the summary notes. Read them along with the lecture. The rules will get fit in your mind. I hope that it's clear. Now, why did we advise to give Ever House? Because in Ever House, there is no IHT. And CGT loss relief will also get allowable if we gift it after arriving to UK. Okay? So the good thing is we are done with 5 marks. We are done with 3 marks, 8. We are done with 7 marks. We are done with almost 15 marks. And now we are moving towards the last part, which is taxation of overseas income. And that is a big one, 10 marks. Let's look at it. Taxation of overseas income. Let's look at what he's asking from us in. Okay. Okay, let's read the email. Taxation of overseas income. Explain why remittance basis will be available to Fiona in the tax year 2022-23 and whether or not she will be subject to remittance-based charge. Calculate the Fiona's income tax liability for the tax year 2022-23 on the basis of her anticipated income figures. So we have to comment on the remittance basis and we have to calculate the income tax liability. We have to comment on the remittance basis and we have to calculate his income tax liability. Okay, let's look at the question. The memorandum. We have read the entire memorandum earlier, but now we are reading the requirement and we are coming back. This is very important. Fiona's anticipated incomes for the tax year 22-23, the year after she moves to UK, is set out below. But first we have to comment on her the remittance basis concept. So let's look at her residence status. Fiona will be resident in the tax year 22-23. Okay. And she is deemed domicile for the purpose of income tax and CGT. Now listen to me very carefully. Fiona is UK resident and she is a UK domicile holder in 2022-23. Okay, for income tax purpose, for income tax and CGT purpose. I will repeat it again. She is a UK resident. She is a UK resident. Fiona will also be UK resident in the tax year 22-23. And she has deemed domicile. And she has deemed domicile in the UK for the purpose of income tax and CGT. Okay, just a second. Fiona is UK resident in the tax year 22-23. She is UK resident and she also has deemed domicile status. Now we are commenting on the tax year 22-23 if I am not wrong. So she is UK resident and she also has the UK domicile. Now I want you all to open the summary notes and revise the individual overseas rules a bit. If a person is resident and he is also a domicile holder, he cannot opt remittance basis. See, this means that Fiona cannot opt for remittance basis. You cannot opt for remittance basis because she is UK resident and domicile holder. I will repeat it again. Opting remittance basis is only available to a person who is resident but not a domicile holder. If you want to revise the rules, you can. I am giving you a lifeline. The examiner will not give you. Okay. Fiona is UK resident and she is UK domicile holder. For income tax and CGT, she is a domicile holder. It was written in the question. She was deemed domicile holder. Now, she is resident and she is domicile holder for income tax and CGT. Now, when you have both the status, you cannot opt remittance basis. Opting is only available to a person who is resident but not a domicile holder. But she is a domicile holder. Now, remittance basis can only be available to Fiona if, or I would say through automatic remittance basis. Now, I hope you remember that there were two types of remittance basis. One was automatic and one was opting. The opting is not available to her because she is resident and she is domicile holder. Now, let's look at automatic remittance basis. For automatic remittance basis, there were two situations. Unremitted amount below 2,000. See, you have to know the rules. If you don't remember the rules and you are not revising it, I cannot help you. You have to know the rules. So if you have forgotten the rules, look at the summary notes. Okay. For automatic remittance basis, there are two situations. Either unremitted amount is less than 2,000 or there is some overseas restriction. Now, I think there was no discussion about overseas restriction in the question. So let's look at her unremitted amount. See, Fiona has property income from property situated in UK 26,000, from property situated in Kerala 31,000. UK bank interest is 1,700, Kerala bank interest is 1,200. The income arising in Kerala is stated gross of Paralian tax. Fiona will remit all of the rental income situated in UK. The interest arising on the Paralian bank account will be retained in Kerala. So her unremitted amount, I'm talking about her unremitted amount. This property income will be remitted. He's saying it here. Fiona will remit all of the rental income in the property situated in Kerala. Now, remittance is in relation to overseas income. UK amount is already in UK. So she will remit the property income, but she will not remit the bank interest. Now, bank interest is only 1,200. See, automatic remittance basis will be available to Fiona as her unremitted amount is only of Kerala, is only of, what is the spelling of Kerala? As of Kerala is of Paralian bank interest, which is of 1,200 pounds, if I am not wrong. Yes, which is of 1,200 pounds. Which is of 1,200 pounds. It's not necessary to insert these signs. If you remember in the exam, you can, otherwise there is no issue. Which is of 1,200 pounds. As unremitted amount is less than 2,000 pounds, therefore automatic remittance basis will be available. Okay. Now, if you remember, in automatic remittance basis, there are no punishments. It's a normal remittance basis. So what did he ask? Explain why remittance basis will be available. It will be available through automatic. And whether or not she will be subject to remittance-based charge. No, there will be no remittance-based charge. No remittance-based charge will apply on Fiona, as she is going for automatic remittance basis. In automatic remittance basis, there is no charge. The charge is on opting remittance basis. Okay. Now, the second thing he asked was to calculate income tax for the tax year 22-23. Okay, not a difficult thing. We can easily do it. Income tax for 2022/23. Okay, I will repeat it again. Now, this is, believe me, these 10 marks are very easy. This entire question was cash marks. Just those 7 marks of part B2 were a bit tricky, but the rest of the question is very easy. Now, what did he ask us? Explain why remittance basis will be available to Fiona. Okay, the first part, and we have to comment on remittance-based charge. So what did we say? Fiona is UK resident and she's UK domicile holder in 22-23 for income tax and CGT purpose. This means that Fiona cannot opt for remittance basis because you are a resident and you are a domicile holder, so you cannot opt. Opting is only available to non-domicile holders. Opting is only available to non-domicile holders. So if opting is not available, then there is only one thing, which is automatic remittance basis. Now, automatic remittance basis will be available to Fiona as her unremitted amount is only Paralian bank interest. Why? Because if you read the memo, there is a property income and there is a bank interest. He is saying that he will remit the rental income. He will not remit the interest. Now the interest amount is just 1200, which is less than 2000. So automatic remittance based charge will be available. Let's start calculating the income tax. Believe me, it is very, very, very easy. Very easy. Okay. Just a second. We are calculating the income tax. Now, this is incomes. This is non-saving. This head is for saving, and this head will be for comments. Okay. Because there is property income and there is rental income. So we have to make non-saving and saving both. And we will write the comments. Okay. Now you can do this calculation on Excel, the spreadsheet also, but I don't prefer using two screens. I simply prefer that use on the one screen and use this manual calculator. Now, the income, what are the incomes she have? She has property income from property situated in UK. UK property income. What is the amount of UK property income? It's 26,000. Okay. 26,000. There is no need to add any comment. Parallel property income. Now, what is the amount of parallel property income? The parallel property income amount is 31,000 and whole of the amount will be remitted. Parallel property income, the amount is 31,000. Just give me a second. 31,000. Okay. The property income goes in non-saving. Whole of the amount, whole of the income is remitted to UK. Then we have UK bank interest. How much is the amount of UK bank interest? If you look at it, UK bank interest is 1,700. Okay. So UK bank interest will go in saving income, and there is parallel bank interest, but it will not appear. This amount is not remitted to UK. Okay, so there will be no tax. It will not be taxed under automatic remittance basis. Okay, so this gives us total income. 26 plus 31 will be plus 31,000. It will be 57,000. Just have patience. I will repeat each and everything. Okay, don't worry about anything. Then we will deduct personal allowance, which is 12,570. Personal allowance will not be wasted as automatic remittance basis is being used. This will give us taxable income. Let me add few rows. So 57,000 minus 12,570. So it's 44,430, and here it is 1,700. Just have some patience. Some students might be understanding here, but some might have got confused, so no need to worry. Now, total taxable income is 44,430 plus 1,700 is 46,130. Fiona is a higher rate taxpayer, therefore 0% band, therefore 0% band of interest income will be of 500. I will repeat it again. Listen to me very, very, very carefully. We are calculating income tax for 2022-23. There is UK property income. You can look at it here, 26,000. Okay. There is property situated in Kerala, which is 31,000. Parallel property income 31,000. These both will go in UK, the non-saving head, 26 and 31. Then there is UK bank interest, which is 1,700. Here it goes, UK bank interest. And there is parallel bank interest, which will be simply ignored because it is not remitted to UK and we are on automatic remittance basis. This gives us our total income, 57,000 and 1,700. We deducted personal allowance. She has not opted remittance basis. Opting was not available to her even. When you haven't opted, your allowance will not be wasted. Then she had taxable income, 44,430 and 1,700. Her total taxable income shows that she is a higher rate taxpayer. So the 0% band of interest income will be of 500. Now we will calculate tax. Non-saving income is 44,430. Now, on first 37,700, we will apply 20%. You know the basic rate band. 37,700 into 0.2. So it's 7,540. And on the remaining, how much is remaining? 44,430 minus 37,700. The remaining amount goes in higher rate band. How much is remaining? 44,430 minus 37,700. So it's 6,730. On 6,730, we will apply 40%. So this gives me 2,692. 2,692. Then we have saving income of how much? 1,700. But on first 500, we will apply 0%. So this gives 0. And the remaining saving income, 1,700 minus 500. So it's 1,200. On 1,200, we will apply 40% since we are a higher rate taxpayer. So it's 480. So this gives us the tax liability 7540, 2692 and 480. So it's 10712. I will repeat it again before moving forward. Believe me, this is simple, basic clerical work. Okay? Just a second. Now, first of all, we classified the incomes in the right head. We arrived at total income, we deducted personal allowance, and we reached taxable income. From taxable income, we determined the 0% band. Then there was non-saving income of 44,430. There was non-saving income of 44,430. Okay. Now on first 37,700, it's 20%. You know that, the basic rate band. And on remaining, it's 40%, 6,730 into 40%. Then there is saving income, which is 1,700. On first 500, it's 0%. And on the remaining, it's 40%. This gives us the tax liability. Now, one last thing is remaining, which is double taxation relief. Why double taxation relief? If you look at the memorandum, here it was written that the rate of tax in Kerala is 18%. So we need to look at double tax treaty, double tax. Now, some students will get confused that, sir, there is no double tax treaty. But you need to know that if there is no double tax treaty, then DTR is lower of UK tax and overseas tax. You have studied it in individual overseas. Even if there is no treaty, we get DTR at lower off. Okay? Double taxation relief. DTR will be available on parallel property income as it was subject to parallel tax and UK tax. DTR will be lower of two things. DTR will be lower of two things. Parallel tax, which is 18% of 31,000. 31,000 into 18%. So it's 5580. And second one will be UK tax on parallel property income. Now we need to calculate it. If you remember the DTR topic, which we have studied in our class, what we do is we place overseas income at the higher bands so that we get greater UK tax. Before moving towards the DTR calculation, I'll give you a brief review of this question. First of all, we commented on the remittance basis. We concluded that opting remittance basis is not available. Only automatic remittance basis is available. Okay. Then we classified all the incomes. We deducted personal allowance. We arrived at the taxable income. And then we have calculated the tax. Before moving to DTR, I want you all to revise what we have already studied. Okay. And then we'll move towards DTR calculation because if you remember, we used to make a sketch. It is something which is a bit tricky, but it will get clear. I think till here, there was nothing to lose. Okay. Now. Okay, so let's take a review before starting the DTR. In the part C, he asked us about the taxation of overseas income. Okay, the first thing which he asked was that whether remittance basis will be available to Fiona or not. Okay, so we said that there are two types of remittance basis. One is opting remittance basis and the other one is automatic remittance basis. Now, when we talk about Fiona, she is UK resident and she is deemed UK domicile holder. Now, how did we know this? It was written in the memorandum, if you remember. It was written in the memorandum here. Fiona will be UK resident on 1st August 2021 under split year, which means that after August 21, she is UK resident. Fiona will also be resident in 22-23. Okay, Fiona will be deemed domicile in UK for the purpose of income tax and CGT. So for income tax and CGT, she's a domicile holder and she's resident. Now, when both of the situations are satisfied, opting remittance basis is not available. Okay, so now what's next? Next is automatic remittance basis. Now, when we talk about automatic remittance basis, it is available when unremitted amount is less than £2,000. So when we talked about Fiona, her overseas income included two amounts. One was property income on property situated in Kerala, and then second one was parallel bank interest. The other two incomes were of UK. Now, Fiona will remit all of the rental income in respect of property situated in Kerala. The interest arising on parallel bank account will be retained in Kerala. So this means that only unremitted amount is this 1,200. Now, since the unremitted amount is less than 2,000, so we said that, okay, automatic remittance basis will be available. Now, when automatic remittance basis is available, you don't face any punishments. There will be no withdrawal of personal allowance or things like that. There will be no remittance-based charge either. Okay? Simply, you can go for remittance basis and there will be no punishment. There will be no remittance-based charge. Then he asked us to calculate the income tax. Now, this is a simple basic tax return, believe me. Normally, we do on the iPad screen on a sheet and I write it. So that looks very simple. Today, we have done it in the format of tables, so some students might face some hesitation. But don't worry. In incomes, there was UK property income, non-saving 26,000. Parallel property income 31,000. UK bank interest will go in saving head. Parallel bank interest is 0 because automatic remittance basis is available and the amount is not remitted to UK. This gives us the total income 57,000 and 1,700. We deducted personal allowance and we arrived at the taxable income. The personal allowance will not be wasted. The personal allowance will not be wasted as we haven't opted for remittance basis. We have got automatic remittance basis. Okay. Now the total taxable income 44,430 plus 1,700. If I add both of them, the total taxable income is 46,130. Fiona is a higher rate taxpayer, so the 0% band of interest income will be of 500. Then I have simply charged tax. Non-saving income is 44,430. On 37,700, it will be 20%. And on the remaining, we will charge 40%. Saving income is 1,700. On 500, I'll charge 0%. And on remaining, I will charge 40% since we are higher rate taxpayer. This gives me the tax liability. Now we have to calculate the double taxation relief. Now, when we talk about double taxation relief, what I need you people to remember is that when we were studying individual overseas issues, I taught you this concept of slicing, that we place overseas income at the higher slice. Like if I look at this non-saving income of 44,430, this 44,430 includes 26,000. This includes this 31,000. So what I will do is that I will place this 31,000 at the last portion so that it gets the 40% band also. Now, obviously, the entire 31,000 cannot go in this 40% band because only 6,730 was taxed at 40%. So on 31,000, 6,730 will go at 40% and the remaining will go at 20%. So UK tax on parallel property income, what will be it? Listen to me, I will repeat it. 6,730 will go at 40%. 6,730 will go at 40%. So that will be 2,692. And the remaining will go in 37,700 back. So the parallel property income was 31,000. So 31,000 minus 6,730. I will repeat it again, so don't worry about these things. And I will tell you one shortcut also. 20%. So this gives me 31,000 minus 6,730 into 20%. So it's 4,854. So the UK tax will be 4,854 plus 2,692. So it will be 7,546. So obviously the DTR will be lower off. It will be 5,580. I will tell you one shortcut also, and I will repeat this also. So don't worry. You know that while you study from me, repetition is free of cost. 10712 minus 5,580. So the final tax will be 5,132. Now, we had to calculate the double taxation relief. The DTR will be available on parallel property income because it was taxed in parallel and it was taxed in UK also. The double taxation relief will be lower of two things. One is UK tax and the other one is parallel tax. One is UK tax and other one is parallel tax. Now, parallel tax was 18%. Okay. The parallel property income 31,000 into 18%, so it's 5,580. Now, the second thing was UK tax on parallel property income. Now, what we do is that in UK, we place the overseas income at higher band so that our DTR gets maximized. So what I will do is that this 31,000 will be given space in this 6,730 so that the DTR gets maximized. On 6,730, it will be 40% and the remaining property income will go at 20%. Now, what was the shortcut which I referred? Now, if a kid who is attempting the exam is smart, listen to me, if the student who is attempting the exam is smart, what he'll do? He'll simply write one statement and he'll close the DTR. See, the Parilian tax was 18% and DTR is lower of UK tax and Parilian tax. If a student will use his mind, he can simply refer to the examiner that the lowest tax rate of UK is 20%. The lowest tax rate of UK is 20%. So this means that DTR will be at Parilian tax rate, which is 18%. Now, even if the property income is taxed in UK at lowest tax band, the lowest tax band is 20%. The lowest tax band is 20%. So if I'll take lower off, obviously Parilian tax will come lower. So you can simply write lower off and you will not be required to do this working. He will write Parilian tax 5580 and then he'll write a statement that as the lowest tax rate of UK on property income is 20%. So double taxation relief, which is lower of overseas tax and UK tax, will be at Parilian tax rate of 18%. See, the DTR is lower of two things. So if the Parilian tax rate is lower and I can see it with my eyes, why I have to do so much calculation? You can just write a statement and you can just put DTR on the Parilian tax. Okay. So if I look at this question, if I go through this question, I think that these 25 marks were cash marks. The part A, becoming Fiona's tax advisor. It was something which I refer as cash marks, cash. Just take it and put in the pocket. 5 marks of ethics. Every time in the exam they'll come, and there are a bunch of requirements which the examiner asks in routine, like he asks that if the client is doing tax evasion, what you'll do. He asks that what are the steps which you need to take while accepting the client. Now, these all routine requirements will be done when we'll be going through different past papers. Then part B1 was a very, very basic part where we have to calculate the IHT only. Very basic. Then part B2 was a bit tricky. Propose gift to Hugo, where we have to talk about CGT and IHT implications. And then part C, taxation of overseas income. Believe me, I don't think that is difficult. It was just a routine requirement. Okay. We made the tax return, we classified the income, we calculated the tax, and then we took DTR. I hope that you people are getting it. Is it clear? So, this is question number 2. Okay. This is question number 2. I'll save it on my desktop, otherwise I'll forget to save. Question 2. Answer 2. Okay. So I'll save it. And then I'll share the PDF also with you so that you people don't have to copy. Okay. If you have any question in our question 2, you can ask me on my WhatsApp. You all have my number. If in any case, if someone do not have, so it's 0092-345-8099-831. And I hope you people remember that we have done question number 1 also. Okay. This was the question number 1. VNL Limited. We have done VNL Limited also. So I'm saving its PDF also. Because I think I have misplaced it. Answer 1. Okay. So 2 questions are done. Now let's move towards another question, which is question number 3. That is also a very easy one. If any one of you have become tired, so it's a recorded session, so you can simply pause me and you can continue it later also. But today I'm not tired. I'll do question number 3 also. Now this is a very easy one, believe me. Let's start. You should assume that today's date is 1st March 2022. Samphire Limited requires advice on the cost of gifting a computer, or alternatively making a loan to one of its shareholder. Calp Limited has requested advice on the tax implication of replacing a factory and acquiring a new warehouse. The following exhibit available on the left-hand side of the screen provides information. Now, you know that this is some basic information that is normally not used in the answer. Let's start reading Semfire Limited and Calc Limited, and let's see that what he is asking from us. Okay. Just a second. Noori. Noori owns 75% of the ordinary shares in Semfire Limited. Noori has been a director of Semfire Limited for many years. Noori owns the whole of the ordinary share capital of Calc Limited. Semfire Limited is a UK resident close trading company which prepares accounts to 31st March annually. Will either gift a computer to Noori on 6th April 2022 or make a loan to Noori on the same date to allow him to purchase a computer. I have told you people already that when you are doing first reading of the question, you need to read it very carefully and don't get frustrated while doing first reading. Okay? Okay. So Semfire Limited will either gift a computer to Noori on 6 April 2022 or make a loan to Noori on the same day to allow him to purchase computer. So what I was saying that when you are doing first reading, read carefully, but don't get frustrated. Don't rush. Because obviously when we do the first reading, we don't know the requirements. We just do first reading so that we can identify the data. Some students say that, sir, if we read the requirements first, then what is the advice? You can do that also, but still you need to read the question to identify the data. Okay. Now, alternative one, Semfire Limited gives the computer to Noori. The computer was purchased by Semfire Limited in March 2021 for £2,600 and has a current market value of £1,500. Semfire Limited has purchased no plant and machinery for several years, and the written down value of its main pool at 6 April will be nil. The sale proceed for the capital allowance will be nil. Noori's private use of the computer has been insignificant throughout the Semfire Limited's period of ownership. So this is some detail given about alternative one. Then there are different situations which are given. So let's look at the requirement if there are isolated marks for it so that we can try it and we can solve it immediately. You should assume that today's date is 1st March 2022. Explain with supporting calculation the total additional taxes payable by Semfire Limited if Semfire Limited gives the computer to Noori. So let's focus and think about this gift of computer. Let's focus and think about this computer because this is an isolated requirement. It has nothing to do with the other parts. Because if you look at it here, the alternative one, it's an isolated requirement. Okay. It has nothing to do with the other parts. Okay. So what I will do is that I will start developing the answer and obviously I'll start thinking in a more precise manner. So the question is Noori or Semfire Limited. We are attempting this part A1. There are no professional marks, so there will be no email or format or things like that. Okay. So part A, explain with supporting calculation the total additional taxes payable by Semfire Limited if Semfire Limited gives the computer to Noori. So let's read the alternative one again and then we'll think in a more precise manner. The computer was purchased by Semfire Limited in March 2021 for £2,600 and has a current market value of £1,500. Semfire Limited had purchased no plant and machinery for several years. The written down value of its main pool will be nil. The sale proceed for the purpose of capital allowance will be nil. Noori's private use of computer has been insignificant throughout Semfire Limited's period of ownership. Now, what is the relation between Noori and Semfire Limited? Noori owns 75% shares in Semfire Limited. Okay, so this means that Samphire Limited is a closed company, and it is written here also. Closed company is a company which is controlled by 5 or fewer shareholders. Have some patience, don't rush, don't frustrate. Listen to me carefully. Believe me, you'll be able to understand. Now, if a closed company, open your notes, open your summary notes, go to the topic of closed company. If a closed company, if a closed company gives any non-cash benefit to its shareholder, how do we treat it? What is the treatment? If the shareholder is an employee also, we treat it as an employment benefit. If shareholder is also an employee, we treat it as an employment benefit. And if he is not an employee, we just treat it as a dividend income. Nuri is a director of Samphire Limited, which means that she's a shareholder and an employee. Have some patience, listen to me carefully, things will get clear. Don't rush. Okay, listen to me. Samphire Limited is a closed company as it is controlled by single shareholder Nuri. Now that was written in the question also, that Samphire Limited is a closed company. So even if someone has not written the reason, that would also be acceptable, but we'll write a complete statement. Samphire Limited is a closed company as it is controlled by single shareholder Nuri. Nuri is also an employee of Samphire Limited. Considering this, gift of computer to Nuri will be treated as an employment benefit. Okay? Gift benefit will arise of how much? What is the market value? What is the market value if you look at it? The market value of the computer is £1,500. Gift benefit will arise of £1,500. Gift benefit will arise of £1,500. Okay. Now, normally, you remember that gift benefit is higher of, one was the working of usage benefit and one was the working of market value. I'll say it again. If you don't remember rules, there is no issue in looking at the summary notes and revising them, because still you have time to go till exam. Okay. The gift benefit is higher of two things. One is the market value working and one is the usage benefit working. Now, if you look at the question, here it is written that the private use earlier was insignificant. So there would be no usage benefit working. Since earlier there was no private use, so there will be no usage benefit working. Only we'll look at the market value to calculate the gift benefit. Okay. How do we calculate the gift benefit? It's higher of, one is the market value working and one is the usage benefit working. Since the earlier private use had been insignificant, so we'll not do the usage benefit working. We'll only look at the market value. Okay, I hope you are getting it. Now, the gift of computer will give rise to a benefit of £1,500. Okay, now on this gift benefit, there will be income tax and there will be NIC. If you look at the question, he says, explain with supporting calculation the total additional taxes payable by Samphire Limited. So Samphire Limited will pay NIC. Samphire Limited will have to pay Class 1A employer NIC on this gift benefit of 1,500 into 13.8%. So this is 15% into 13.8. So it's £207. Okay, so it has to pay Class 1A employer NIC. Okay, now Okay, so Samphire Limited will have to pay Class 1A employer NIC on this gift benefit of 1500 into 13.8%. This Class 1A, I will repeat everything again, so don't worry. This Class 1A employer NIC will be an allowed expense from corporation tax return for Samphire Limited. After tax cost will be 207 pounds into 1 minus 19%. I will repeat it again. So don't worry. Just listen to me carefully. Will be 168 pounds. So please repeat it. Now see, things are very simple, but it's just doing it carefully. What was the question? Explain with supporting calculation the total additional tax payable by Samphire Limited. Explain with supporting calculation the total additional tax payable by Samphire Limited, not by Nouri. We have to look at Samphire Limited. Now, Samphire Limited is a closed company as it is controlled by a single shareholder, Nouri. Nouri is an employee of Samphire Limited. Considering this gift of a computer to Nouri will be treated as employment benefit. If you remember, non-cash benefit given to shareholder has two situations. Situation number one, give to a shareholder who is also an employee. Give to a shareholder who is also an employee. It becomes employment benefit. Situation number two, give to a normal shareholder who's not an employee. It becomes dividend income. Now, since Nouri is also a director, so this will become a gift benefit. Now, when we do the working of gift benefit, we look at the market value. And the other working is of usage benefit. But here we will not do the working of usage benefit because Nouri's private use throughout the Samphire Limited period of ownership was insignificant. So there would be no usage benefit. The gift benefit will be based on market value. Now on this gift benefit, income tax will be payable. But that income tax will be payable by Nouri. We are not doing working for Nouri. We are doing working for Samphire Limited. So Samphire Limited will be subject to Class 1A employer NIC. Okay. Now, whatever expense we do for an employee, it becomes an allowed expense. Listen to me. On this 1500, Samphire Limited will pay a Class 1A employer NIC. Now, while making its corporation tax return, Samphire Limited will claim an allowed expense. While making its corporation tax return, Samphire Limited will claim an allowed expense. Because whatever you give to an employee, whatever you pay for an employee, you claim allowed expense. Now, when Samphire Limited will claim an allowed expense, it will get relief in corporation tax return at rate of 19%. So what I have done is, NIC is 207. After tax cost, if you remember your financial management, you used to do cost after tax KD, KD1 minus T. Remember F9, FM paper? After tax cost. So 207 was the NIC after tax, because we'll get the allowed expense relief. So after tax cost will be 168. Now let's think more about Samphire Limited. For Samphire Limited, in capital allowance pool, there will be no adjustment as pool balance is currently zero, and sale proceed of computer for the purpose of capital allowance is also zero. So where it was written, it was all written here. You just need to read carefully. Samphire Limited had purchased no other plant and machinery for several years. Written down value of its main pool will be nil. The sale proceed for the purpose of capital allowance will be nil. Okay. So in capital allowance pool, there will be no adjustment. So whenever we dispose an asset, we think about capital allowance and we also think about CGT. Now, what about CGT? In CGT, it will be an exempt asset as cost and DP both are below 6,000. In CGT, this computer will be exempt as its cost and disposal proceed both are below 6,000 pounds. Now, what I say to my students always is that if you look at this answer, if you read the question and then you read the answer, you'll say that, oh, it's very simple. And yes, it is very simple. There is no two opinions on this matter. But the important thing in advanced taxation is about remembering the rules. The important thing in advanced taxation is about remembering the rules. You need to pick up, oh, it's a closed company. We are gifting to a shareholder who is also an employee. So there will be employment benefit. Then you have to think about the NIC. You have to think about the allowed expense. You need to think about capital allowance. You need to think about CGT. If a teacher starts telling, oh, think about this, you can answer. But your own mind should reach that topic. And how will you develop this approach? The key is practice. The key is practice. Until and unless you will do 6-7 past papers, your approach will not get developed. Do past papers on your own. Attend these sessions. It is not necessary that you do all the papers with me. You can do some on your own also. Attempt it on your own. Do on the exam software. I have told you how to go to this software test reach. Match your answer with my answer. If you feel difficulty, then look at the video. But until and unless you will practice on your own, you will not be able to develop the approach. See, when you read the answer, it is simple. It's a closed company. You are gifting an asset to a shareholder who is also an employee, so it will be an employment benefit. It is very basic to calculate the gift benefit. Now we have to think about the cost for Samphire Limited, not for Nuri. So for the Samphire Limited has to pay NIC. On NIC, it will get allowed expense. For Samphire Limited, it will be a capital allowance pool adjustment. There will be CGT consideration. It is about remembering the rules. This is important. I hope that you people are getting it. Now let's go to second requirement. Part 2, if Samphire Limited makes a loan of £1,500 to Nuri and then writes off the loan on 6th April 2024, what will be the tax implications? We have to think. There are 6 marks available. Let's read the alternative 2 also. Now, we will go in the exhibit and we will read the alternative 2. On 6th April 2022, Samphire Limited will make an interest-free loan of £1,500 to Nuri. Now, if you people remember, that when a closed company gives a loan to its shareholder, please tell me. Open the summary notes. Start using your mind. When a closed company gives a loan to its shareholder, you have to pay a deposit, a notional tax to the tax department of 32.5%. You start using your mind. Sapphire Limited is a closed company. It is giving loan to its shareholder. Okay. And Nuri owns more than 5% shares, so the exemption will not be available. You should remember this. The ownership of Nuri is 75%. The ownership of Nuri is 75%. There was an exemption also, but the exemption applies if the loan is of less than 15,000, person is an employee and his shareholding is less than 5%. But Nuri's shareholding is 75%, so the exemption will not apply. Believe me, it's so easy. Now let's look at it. If Sapphire Limited will give loan to Nuri, it will be a loan by closed company to its shareholder. It will give rise to a notional tax at rate of 32.5% on amount of outstanding loan at year end. It will be payable. It will be payable by Sapphire Limited. Now, if you look at the situation, the loan will be outstanding because loan will be given in 2022 and it will be written off in 2024. Between 2022 and 2024, obviously there will be a year end because the year end is 31st March. So yes, we have to pay the deposit. Okay. As loan will be outstanding at year end, therefore, a notional tax of, let me copy that pound sign. Therefore, notional tax of 1,500 into 32.5%, 1,500 into 32.5% of 488 pounds will be payable. Exemption of notional tax will not apply as Nuri's shareholding is more than 5%. Okay. Loan is interest-free. Therefore, loan benefit may also arise. However, it will be exempted as loan balance is less than 10,000. See, if you read the question, and then you read the answer, it's very simple. But the important thing is about remembering the rules, using your mind, alertness. In taxation, the important thing is remembering the rules. I will repeat it again. Sapphire Limited is giving a loan to its shareholder, Nuri. Sapphire Limited is giving a loan to its shareholder, Nuri. Now, when a closed company gives a loan to its shareholder, a notional tax of 32.5% gets payable. If you remember the closed company chapter, which you have studied in corporation tax. If you don't remember, open the summary notes and just revise it. Okay. A deposit, a notional tax of 32.5% is payable. Now, the loan was given in 2022 and it will be written off in 2024. We haven't discussed the written off situation yet. Okay. Now, when the loan was given, a 32.5% deposit will be payable. Now the notional tax, this 32.5% gets exempted when three conditions are met. Loan is of less than 15,000, shareholder is an employee, and shareholding is less than 5%. But here the shareholding is 75%, so the exemption will not be available. Now, since the loan is interest-free, so the loan benefit should also arise. But here the loan benefit will not arise. The loan benefit will not arise. Why the loan benefit will not arise? Because the loan balance is less than 10,000. Now, this is the separate thing. Notional tax is separate and loan benefit, which is the interest adjustment, that is separate. Notional tax will be payable. The notional tax, which is 32.5%, this will be payable. But when we talk about the loan benefit, that is exempted because the loan is less than 10,000. In loan benefit, there is only one requirement, that if the loan is less than 10,000, no loan benefit will arise. Now let's think about the write-off. Let's think about the write-off. When Sapphire Limited will write off this loan, on 6 April 2024, Tax Department will return the notional tax paid of £488. Now, this amount of £1,500 will be treated as a dividend paid to Nuri. On this dividend, income tax will be payable by Nuri. For Sapphire Limited, paying dividend will not create any tax implications. Tell me, is it difficult? I think that there was nothing difficult in it. These were the cash marks. Believe me, these are cash marks. Okay, so let's read it again. Part 1, he asked that if we gift a computer to Nuri. Now, Nuri is a shareholder of Sapphire Limited. Sapphire Limited is a closed company. If we give any benefit to a closed company's shareholder who is also an employee, it becomes an employment benefit. Okay, it becomes an employment benefit. There will be a gift benefit on which Sapphire Limited has to pay Class 1A employer NIC. This Class 1A employer NIC will be allowed expense for the Sapphire Limited, and it will claim the corporation tax relief. In capital allowance pool, there will be no adjustment because the pool balance is 0 and the proceed for capital allowance purpose will also be 0. This was entirely written in the question. I haven't done anything. In CGT, it will be an exempt benefit as cost and DP both are below 6,000. Is it clear? Now, part 2. If Sapphire Limited makes a loan of 1,500 to Nuri and then writes off the loan on 6th April 2024. Again, if a closed company gives a loan, to its shareholder, then a notional tax of 32.5% is payable. So if Sapphire Limited will give loan to Nuri, it will be a loan by closed company to its shareholder. It will give rise to notional tax, which is calculated. The exemption of notional tax will not be available as Nuri's holding is more than 5%. Loan is interest free. You have to think about loan benefit, but no loan benefit as loan balance is less than 10,000. Now, when Sapphire Limited will write off this loan, it will become a dividend income on which Nuri has to pay income tax. It's read the requirement if anything is left. If Sapphire Limited makes a loan of 1,500 to Nuri and then writes off, we have to talk about, explain with supporting calculation, the total additional tax payable by Sapphire. Believe me, it's so simple. And if you see, we have done 10 marks out of 20. Is it clear? Done? Now let's do another one. Part B1. Let's bring it here. You know my approach. I don't teach difficult. Whatever question you'll do with me, it will always be simple. Okay. Now, part B1, calculate the chargeable gain for Calp Limited on the sale of the lease on Factory 1. Let's look at what is this. So we are done with alternative 1. We are done with alternative 2. Now we are reading this Calp Limited disposal of lease on factory. Calp Limited is a UK resident trading company. Calp Limited was assigned a 48 years lease on a factory building, referred as Factory 1, on November 15, for which it paid a premium of 165,000. So Calp Limited has purchased a lease for 165,000. Calp Limited used Factory 1 in its trade until 30th April 2021, since when it has been rented to tenants who are not connected with the company. On 1st November 2021, Calp Limited sold the lease with 42 years remaining for 206,000. Now again, this is a very basic concept. If you remember your capital gain tax, we have studied the concept of disposal of leases. We have studied the concept of disposal of leases. Only thing which we have to do is that we have to adjust the cost, because the disposal proceed is of 48 years, the disposal proceed is of 42 years, whereas the cost is of 48 years. I will repeat it again. We are selling the lease. We have studied it in CGT. You can go and refer that also. We are selling the lease with 42 years remaining. So the disposal proceed of 206,000 represents 42 years, whereas we purchased the lease for 48 years. So the cost of 165,000 represents 48 years. So we need to adjust the cost. And since the lease is assessed in income tax and CGT both, we use the lease percentages. If you look at the requirement, they must be given here. Here the percentages are given. 48 years and 42 years. Okay, listen to me, I'll calculate, you'll be able to understand. It's not difficult one. We just need to calculate it. And it's a part of 3 marks only. Disposal proceed. What is the disposal proceed? Disposal proceed is 206,000, which represents 42 years. 206,000. Disposal of lease with 42 years remaining. Now we will deduct the adjusted cost. What was our cost? Our cost was 165,000. Calp Limited was assigned, which means we purchased it for 48 years and we paid a premium of 165,000. So originally the lease was purchased was 48 years. Originally lease was purchased for 48 years. Cost will be adjusted. Now, how do we adjust the cost? How do we adjust the cost? Just look at it. Our cost was 165,000. Our cost was 165,000. We will divide it by 48 years. Now, instead of using the years in lease, we use these percentages. 99.289%. We use these percentages. We are dividing it with 48 years percentage, and we will multiply it with 42 years percentage. The 42 years percentage is 96.593. I will repeat it again, so don't worry. 165,000 divided by 99.289 multiplied by 96.593. So it's 160,520. I will check it again. 165,000 divided by 99.289 multiplied by 96.593. So this gives me chargeable gain. I will repeat it again, so don't worry. 206,000 minus 160,520. So the chargeable gain is 45,480. Now, since it is corporation tax, so we will deduct indexation allowance. Now, what will be the indexation allowance? When did we purchase this lease? It was purchased in November 2015. And you know that indexation is frozen on December 17. Lease was purchased on 1st November 2015. Indexation allowance will be till December 2017. You know that indexation allowance is frozen. In the requirement, the index factor is given. November 15 to December 17, it's 0.070. This is the index factor. Indexation allowance is equal to 160,520 multiplied by, I will repeat it again, don't worry, 0.070. 0.070. So the indexation allowance will be 160,520 into 0.070. So it's 11,236. This gives me the taxable gain 45,480 minus 11,236. So it's 34244. Let's repeat it. Some students might have got confused, and the reason being that they might not remember the issue of these leases. Let's look at it again. Just a second. Now, it was a small part of 3 marks. He asked us to calculate the chargeable gain for Calp Limited on sale of the lease on Factory 1. Okay. Now, if I read it again. On 1st November 2021, Calp Limited sold the lease with 42 years remaining. So when he sold the lease, the disposal proceed will be 206,000, and there is no debate in it. The disposal proceed is straightforward. There is no adjustment in disposal proceed. The disposal proceed is 206,000. The disposal proceed is 206,000. Okay. And the disposal proceed represents 42 years of lease. Now, Calp Limited was assigned a 48 years lease, which means that the cost is of 48 years. The cost is of 48 years. Now, it's not like with like. We need to adjust it. Normally, in normal rights, if you remember CGT, I have taught you this. In normal rights, we just adjusted divide by 48 years multiplied by 42 years. But in leases, we use lease percentages. Now, lease percentages will be given in the paper. You don't need to worry. So, cost 165,000 divided by 48 years multiplied by 42 years. Here are the lease percentages. 48 years, 99.289, and 42 years, 96.593. Okay, so this is the adjusted cost, chargeable gain, indexation allowance. The lease was purchased in November 15. It was sold in 2021, but the indexation allowance is frozen in December 17. You know that. And if you don't know, it's better to revise it. And this gives us the taxable gain. So how many marks we have put in our bag? 3 more marks. I think it's very much simple. I think that what I have to teach the concept in it because the questions are so simple. It's just doing it. Still, if someone has any query, you all have my WhatsApp number to ask. Okay. Let's put part B2 and then first we will revise the answer we have done till here before doing this. Okay, this is a 7 marks part. Now, let's read what we have done till here. In part A, there was a simple first part, gift of computer to a shareholder who is also an employee. So we talked about employment benefit, we talked about NIC, we thought about capital allowance and CGT. Okay, whenever a company is gifting an asset to a shareholder who is also an employee, it becomes an employment benefit. And since it was a gift, so gift benefit will arise. There is no usage benefit consideration in the question because the use of computer was insignificant before the gift. So we just used the gift benefit market value approach. Then there was class 1A. Then there was class 1A, employer NIC. Payable by Semfire Limited because on gift benefit it gets payable. Then we discuss the allowed expense issue because whatever expense we do on behalf of our employee, it becomes an allowed expense. The after tax cost because he asked us the total additional taxes. Then in capital allowance, there will be no implication because pool balance is 0 and the disposal proceed is also 0. Then in CGT, it is exempt. Part B2, loan to a shareholder, notional tax deposit. Exemption is not available as shareholding is more than 5%. Loan interest benefit will be exempted because loan balance is less than 10,000. And then write-off of the loan, it will become a dividend. And then there was CGT on sale of a lease. Is it clear? Done? Now let's look at the last requirement. This was a very easy paper. Okay, so let's read part B2. Explain with supporting calculation the amount of chargeable gain calculated in part B1. Now this is the amount of gain which we have calculated, which will remain liable to corporation tax if Calp Limited claims the maximum amount of rollover relief. Now, if you remember the rollover relief, for rollover relief, it is necessary that we reinvest the proceeds and there should be business use. Explain with supporting calculation the amount of gain calculated in part B1, which will remain liable to corporation tax if Calp Limited claims the maximum amount of rollover relief available. Now, let's look at the question. Now, Cloud Limited has acquired a factory and it has acquired a warehouse. Are you getting it? Now, let's start developing the answer step by step and we'll read it along with that. It's very simple. Listen to me. In order to claim rollover relief on gain of disposal of lease, it is necessary to look at business use portion and on reinvested amount in business use. Listen to me. In order to claim rollover relief on gain of disposal of lease, it is necessary to look at business use portion and on reinvested amount in business use. Now, if we look at this leased asset, Calp Limited used Factory 1 in its trade until 30th April 2021. Since when it has been rented to tenants who are not connected with the company. On 1st November, it sold the lease. Now see, the lease was purchased in November 15. The lease was purchased in November 15. Now November 16, November 17, November 19, 16, 17, 18, 19, 20, and November 21. So the total ownership period is 6 years. From November 15 to November 21, 16, 17, 18, 19, 20, and 21. The total ownership period is 6 years. Please listen to me. The total ownership period is 6 years. Now, in this total ownership period, it was used in trade till 30th April 21. So how many months of business use? November 16, November 17, November 18, November 19, November 20. 5 years. And then November, December, January, February, March, April. Now listen to me. Lease of the factory was owned for 6 years. 1st November 2015 to 1st November 2021. In this ownership period, business use portion was 5.5 years. From 1st November 2015 to 30th April 2020. Okay, rollover relief will only be available on business use portion. Total gain on sale of leases 34244. Gain eligible for rollover relief is 34244 into 5.5 years divided by 6 years. I will repeat it again, so don't rush. Listen to me carefully, things will get clear. 34244 divided by 6 years multiplied by 5.5 years. So it's 31390. In order to defer this gain eligible for rollover relief, Calc Limited has to reinvest business use portion proceeds in business use assets within 1 year before or 3 years after date of disposal. Business use portion proceeds, I will repeat it again, so don't get frustrated. I will repeat, okay? Have some patience and listen. Business use proceeds of sale of factory, sale of lease was, the total proceed was 206,000 divided by 6 years multiplied by 5.5 years. So 206,000 divided by 6 into 5.5. So it's 188,833. Let's repeat it. Let's repeat it because I know that some students might have got confused. Okay. Now, these are a bit tricky, but not too much. Now, in order to claim rollover relief on gain of disposal of lease, it is necessary to look at business use portion. We need to look at the business use portion, that whether it is reinvested or not. Now, lease of the factory was owned for 6 years. Lease of the factory was owned for 6 years. We need to first identify the business use. Lease of the factory was owned for 6 years, November 15 to November 21. Lease of the factory was for 6 years. We owned it for 6 years, November 15 to November 21, which is 6 years. Business use was till 30th April. If you can look at here. Because after that, we rented it out. Calp Limited used Factory 1 in its trade until 30th April, since when it has been rented out to the tenants. So business use is still 5.5 years. Rollover relief will be available on business use portion. So the gain which is related to business use will be eligible for rollover relief. Now, in order to defer this gain, Calp Limited has to reinvest the business use portion proceeds. And the total proceeds are 206,000. Now, if you remember, if you have forgotten the rules of rollover relief, my first advice is to open up your register, open up the summary notes, okay, and then look at the rollover relief business use concept. I used to split the gain between business and non-business. Rollover relief is only on business use concept. Okay, so we have the business use gain. We have this business use gain, and we have this business use proceed. Now, if we reinvest this 188,833, our business use portion gain will get deferred. Now, Calp Limited has done reinvestment in. Now, let's look at the reinvestment. Acquisition of Factory 2. Calp Limited acquired a Factory 2 from Samphire Limited. Now, what is the relation between Calp and Samphire? Let's look at it. Let's look at it. Noori owns 75% shares in Samphire, and Noori owns whole share capital of Calp. Noori owns Samphire and Noori owns Calp Limited. But you need to be very clear here that since the shareholder is an individual, Noori owns Samphire and Noori owns Calp Limited. Since shareholder is an individual, so capital gains group will not be formed. For capital gains group and 75% group, shareholder should be a company. Here, the shareholder is an individual, so capital gains group will not be formed. These two companies are separate. Okay. Calp Limited acquired factory building on 1st May 21 and immediately started to use it in its trade. Samphire Limited acquired factory 2 for 96,000. We don't care about it. Calp Limited paid 138,000 for the factory. So yes, Calp Limited has reinvested some of the proceeds. Listen to me. Calp Limited has done reinvestment in Factory 2, which it purchased from Samphire Limited. Purchase of factory from Samphire Limited will be a normal purchase. Will be a normal purchase of asset, as Calp Limited and Samphire Limited are not part of capital gains group because their shares are owned by an individual, Noori. Okay. Now, reinvestment in Factory 2 was done on what date? was done on 1st May 2021. And the previous asset was sold in November 2021. So the limit is that we can go back up till 12 months. 12 months before or 3 years after. I will repeat it, so don't worry about it. Reinvestment in Factory 2 was done in May 2021, which lies in qualifying period, which lies in qualifying period of disposal of Factory 1 done in November 2021, because we can go back up till 12 months. I will repeat the thing, so don't worry. Factory 2 is entirely used for business purpose. So its reinvestment can be used to defer gain. Reinvested amount is how much? Reinvested amount is 138,000. Calc Limited has paid 138,000. Just a second, I will repeat the things again. Reinvested amount is 138,000. This will cover required reinvestment of 188,833 partially. Okay, now let's move forward. Calc Limited has also done one more reinvestment. Okay, I will repeat the things, so don't worry. Okay, just listen to me currently. Calc Limited has also done another reinvestment in a warehouse. If you read the question, Calc Limited acquisition of a warehouse. Calc Limited will acquire a warehouse from an unconnected company for 78,000 on 1st April 2022. Now that is also within the qualifying period, because we can go up till 3 years after. Calc Limited will occupy 70% for its trade and will rent out remaining 30%. Okay, let's come back. Calc Limited has done another investment in warehouse in April 2022. This is also in qualifying period. In qualifying period of disposal made in November 2021. Amount reinvested for business purpose is 78,000 into 70%, because it is stated that 70% will be used for business. So 78,000 into 70%. So it's 54,600. Okay. Total reinvestment made for business purpose is how much? One amount is 138,000 and other one is 54,600. In Factory 2, we reinvested 138 and here we reinvested 54,600. Lost 138,000 is 192,600. This will cover entire business use proceed of sale of lease of Factory 1. Okay. This will cover entire business use proceed. How much was the proceed? 188,833. This will cover entire business use proceed of 188,833 of sale of lease of Factory 1. Business use portion gain of 31,390 will get rolled over. Remaining gain, which is related to non-business use, will continue to be chargeable for corporation tax purpose. Okay, so what is the amount of that? The total gain was 34244. 244 minus 31390. So it will be 244 minus 31390. So it's 2854. Now, this was a bit technical requirement, but we will review it again so that it gets clear. Just listen to me carefully. Explain with supporting calculation the amount of chargeable gain calculated in B1, which will remain liable to corporation tax if Calp Limited claims the maximum amount of rollover relief. See, listen to me carefully. I will repeat it again. Some students might have got it clear in the first go, but some might not have understood yet. So we look at it while listening to the question again. It will get clear. Okay, now, in order to claim rollover relief on gain of disposal of lease. Now, this was the gain on disposal of lease. It is necessary to look at the business use portion and reinvested amount in business use. Now, the lease of the factory was owned for 6 years. Lease of the factory was owned for 6 years. Lease of the factory was owned for 6 years. Now, in these 6 years, business use was 5.5 years. Now, in these 6 years, the business use was 5.5 years. Because if you read it, in the last 6 months, it was rented out to the tenants. So the rollover relief is only on business use. Rollover relief will only be available on business use portion. Total gain on sale of lease is 34244, and we prorated it, divided by 6, multiplied by 5.5 years. That gives us 31390. Now, this gain can be deferred because this is what we say is related to business use. Now, obviously, we don't reinvest the gain, we reinvest the proceeds. So we need to look at the proceeds amount. In order to defer this gain, eligible for rollover relief, Calp Limited has to reinvest business use portion proceeds in business use assets within 1 year before or 3 years after. Now, obviously, I'm not teaching you the rules. I expect that you people remember the rules. I expect that you remember the rules. So divided by 6 years, multiplied by 5.5 years. So business use portion proceed is 188,833. Calp Limited has done reinvestment in Factory 2. Now, first we looked at the disposal. Business use gain, business use proceed. First we looked at the disposal. Now we are looking at reinvestment. Now we are looking at reinvestment. Now 2 reinvestments were done. One was in Factory 2 and one was in warehouse. So Calp Limited has done reinvestment in Factory 2, which it purchased from Samphire Limited. Now see, some students might got confused that Samphire Limited is part of our group. No, it's not part of our group because our parent is Noori, who is an individual. And with individual, there is no group. Okay? From Samphire Limited will be treated as a normal purchase of asset, as Calp Limited and Samphire Limited are not part of capital gains group because their shares are owned by an individual. Reinvestment in Factory 2 was made in May 2021, which lies in qualifying period because we can go back up till 12 months. Factory 2 is entirely used for business and its amount is 138,000. You can read it here. The Factory 2 is of 138,000. Okay, and it will immediately be used in trade. The other reinvestment is warehouse, which is of 78,000. It was purchased in 2022, but yes, we can go up till 3 years. We looked at the business use portion reinvestment. Total reinvestment is 138 plus 54,600, which is 192,600. Our required reinvestment was 188,833. So the business use portion gain will be deferred. Remaining gain, which is related to non-business use, will obviously not be deferred. So if you look at this question, part A1 was easy. Part A2 was also very easy. Part B1 was also very easy. But B2 was a bit tricky, and it would require some alertness from students. So here comes our answer 3. Okay. If anyone has any query, people can ask me on WhatsApp. So today we completed our question 2 and we completed our question 3. In the next class, we'll move towards the question number 4 and we'll complete this paper, and this is how we'll continue, and we'll do 5, 6, 7, 8 papers. And I always say that it is on liberty of students that they can look at the videos or they can try the questions on their own also. Some students might be thinking that it is difficult and how we'll do. My advice is that don't get frustrated. This is the starting. When you will do 5, 6 papers, it will get very easy for you. The purpose of these revision sessions is to give you a confidence that how you have to deal with complete papers. Okay? Thank you, everyone.